Well, it must be said that private equity is really an attractive profession. I've been doing it for 20 years and I love it. You get the security of a management fee, plus the upside of carried interest, and you get a more long-term perspective and career than investment banking, and a more exciting career than corporate management. For most of the 7,000 or so private equity firms worldwide, it's like having your own middle-sized business. A private equity fund manager who goes out and raises a fund is really a kind of financial entrepreneur who's got his own business. And here I'm not talking about the very few large groups which function more like investment banks who have a lot of staff and a corporate hierarchy like Carlyle or KKR. There's no shortage of aspiring fund managers, either people at a more senior level trying to raise their own funds, or people of a junior level trying to get a job with a large private equity group or even a mid-cap group. So fundraising is actually the key to becoming a private equity fund manager. If you can persuade a group of investors to put up some money, you've got your fund, you're in business. Sounds simple, doesn't it? Then why do more than 9 out of 10 aspiring fund managers fail? Good question. Many aspiring fund managers who are otherwise valid investment professionals have a little bit of an unrealistic optimism bias when it comes to fundraising. Fundraising is a long, hard road where you might need to visit 100 potential LPs to get just 1 or 2 commitments. Before we discuss LPs, the fundraising process and its costs, let me tell you about 4 main mistakes made by aspiring fund managers trying to raise a fund. The fact they make these mistakes is partly understandable for one simple reason. Everybody lies. Almost all GPs publicly lie about how easy and smooth their fundraising was, making out it was a breeze. Don't believe them. But when people hear this, they assume it's easy and don't like to hear the truth, lost as they are in their hubris before the brutal come down. The first mistake is underestimating the duration of the internal decision-making processes of LPs, which can be very slow. The second mistake is taking at face value the verbal expressions of interest by LPs. How many times have I heard that meeting went well, only for nothing to happen? I would never trust what an LP said at a fundraising meeting. The third mistake is underestimating the cost of fundraising, which can escalate while at the same time there is no light at the end of the tunnel. The fourth mistake is putting together a team which basically collapses halfway through the process due to different levels of commitment of the various people. Some of them may try to fundraise on the side, keeping their day jobs. Others will go in without having really clear ideas about anything, and I've seen that very often. Okay, so having now eliminated 9 out of 10, if not more, of aspiring fund managers, based on those 4 mistakes right there, let's get into some of the important aspects of private equity fundraising. The universe of LPs or their funds available will be more limited than with other asset classes. This is due to the huge risk factors specific to private equity, which are the lock-up period and the blind pool nature of private equity investing. The lock-up means that LPs cannot get out once they have committed to a private equity fund, and this commitment is a long one, up to 10 years. That's one. Secondly, the blind pool means that LPs have no idea at the beginning what the portfolio would look like, apart from knowing the general investment strategy of the fund, which could well drift halfway through. It therefore becomes important for aspiring fund managers to have a clear fundraising strategy, rather than just phoning around, hopefully, contacts or contacts of contacts. We can segment potential LPs like we would customers in marketing. Private equity is the asset class where investors have the most non-financial objectives and agendas, and this needs to be understood by those trying to fundraise. Some of the LPs may have investments in over 100 GPs, which requires dedicated teams in-house on their side to manage. Pension funds, insurance companies, sovereign wealth funds and university endowments tend to be driven by financial returns. Banks may be looking for synergies with their corporate lending or investment banking and underwriting business. Corporates may be looking for a window into innovative sectors and new technological trends in the venture world. Development institutions may have a developmental agenda for the society in which the private equity fund will operate. Impact investors may want to see social good being incorporated into the private equity investments. A fund of funds needs to show its own investors that they're very smart and good at assessing GPs. So all these different agendas of different LPs can make for a complex set of non-financial objectives to be catered for. Therefore, the aspiring GP needs to have a segmentation strategy. Doing a buyout fund in the UK will attract different investors than a fintech fund in Dubai. Having segmented the LP market, our aspiring GP will need to engage with a fundraising process. This means time and it means money. A first-time fund manager may need 18 to 24 months to raise a fund. A follow-on fund may be less, maybe 12 months or so. The process has a very long preparatory phase in which potential LPs are canvassed informally for their interest, opinions and feedback. Then a decision is made to go ahead with the fund and how and where the fund and related entities will be created. Promotional and legal documentation is drafted. Outside advisors such as lawyer and accountants are appointed. So now the costs are rising and the clock is ticking. Preliminary commitments are secured from a first closer and more friendly group of investors. Then, armed with this interest, a wider group of investors is approached. Once this is done, commitments are firmed up via legal documentation and the fund reaches its closing. A major part of the process will be the pitch made by the aspiring fund manager to the LPs. This usually takes the form of a group pitch of the team in an hour or so meeting with the LP, backed up by a PowerPoint presentation followed by questions and answers. So having a well-constructed pitch book is important. Typically, there need to be three main sections: the investment strategy of the fund, the team and their track record, where the fundraising process stands at the current time. Going into a pitch with some LP commitments secured gives the GP a much stronger hand to play. I mean, no one likes to be the first to jump in. Some of the questions the LPs may ask can include things like this: how many investors of your previous fund are investing in this one? What was your worst investment and why? Is your strength finding deals, making deals, or managing the portfolio? Can we see your management company budget? How fairly spread is the carried interest by level of seniority? Who owns the GP and why this ownership structure? Who will be on the investment committee? Can we have a seat? So many of these and other questions will be very probing, especially in the case of experienced LPs. So fumbling the answer may well be the kiss of death. All possible questions need to be anticipated and the answers rehearsed. So rehearsing your pitch is vital. There are a couple of things that can be done to improve the odds of fundraising. One is to find an anchor investor. This is an investor who believes in the team from the get-go and supports their fundraising efforts through an initial commitment and helping with fundraising, perhaps by calling around and making introductions. An anchor investor who is expert and credible will send a strong signal to the market that the proposition of the GP has merit and is worth looking at. Another way of improving the odds is for the GP to hold what is called a first closing of the fund before the full target amount has been reached. So if my target fund size is, say, 300 million euros, I can start the fund with just 120 million maybe, and the other LPs who were still sitting on the fence will now be more encouraged to sign up because they see it's real. There's offices, the team's actually working, there's money flowing, maybe an investment is actually being made already. It's important to get fundraising right, given that you've got nothing to show for a failed fundraising except costs. That's a real disaster. And raising even a relatively small fund, such as 100 million euros, can cost a lot, and economies of scale are limited. This is especially challenging for a first-time team who cannot use the management fees of a previous fund to cover these costs. And raising even 100 million euros can easily cost over €250,000. One survey I saw estimated that in the year 2020, 5% of new funds raised were from first-time fund managers. By the year 2014, this figure had fallen to just 4%. So in conclusion, I would say good luck to all you aspiring fund managers. You're going to need a hell of a lot of it.